Before diving deeper into building automated trading systems, we first need to understand the environment they operate in. Financial markets. These are platforms where buyers and sellers exchange assets like stocks, currencies, commodities, and even cryptocurrencies. Brokers and exchanges act as the middle layer, connecting participants and facilitating transactions. What makes these markets tick are their underlying structures, things like order books, liquidity, and price discovery. A trader's strategy is only as effective as their understanding of these mechanics. For algorithmic traders, this knowledge is essential. The systems you build need to interact with these structures in real time, executing trades with precision. In this lesson, we'll map out the landscape of markets, how they function, and why mastering these fundamentals is critical for success in automation. Financial markets come in many forms, each with its own characteristics and opportunities for algorithmic trading. The foreign exchange, Forex market, is by far the largest, with a daily volume of $7.5 trillion. Because it operates 24 hours a day, 5 days a week, and offers deep liquidity, it's well suited for continuous algorithmic strategies that thrive on constant price movement. Then we have commodities like gold, oil, and agricultural products. These add diversification to a portfolio and are often shaped by seasonal supply and demand patterns, factors that systematic approaches can model and trade effectively. Stock indices like the S&P 500 or NASDAQ represent baskets of shares and allow traders to capture broader market movements without focusing on individual companies. Index futures even provide leverage, letting traders gain exposure with smaller amounts of capital. Finally, there are cryptocurrencies. Unlike traditional markets, crypto never closes. It runs 24/7 and is highly volatile, which creates both opportunity and risk. Algorithms here must include advanced risk management to survive the extreme swings. Together, these markets form the ecosystem in which your trading systems will operate. To participate in these markets, you don't trade directly with exchanges. You go through a broker. Brokers serve as your gateway, connecting you to global financial venues. They aggregate liquidity from multiple sources, such as banks, hedge funds, and market makers, in order to offer competitive pricing to their clients. The process follows 3 key steps. First is market access. Your broker maintains direct connections with exchanges and liquidity providers. Second is order routing. Your trades are passed through networks designed to secure the best possible prices at that moment. And third is execution, where the order is matched and filled, often within milliseconds. For algorithmic trading, this infrastructure is critical. The quality of a broker's systems, particularly low latency connections and reliable execution, directly impacts your results. Delays or poor fills can eat into performance, especially when your strategy relies on speed and precision. In many ways, your broker's technical backbone becomes just as important as the strategies you design. Every trading system depends on one thing: orders. These are instructions that tell the market what to do with your positions, and understanding the main types is crucial for algorithmic trading. A market order is the simplest. It executes immediately at the current market price. This makes it perfect for breakout strategies where speed matters more than precision, but it comes with the risk of slippage in fast-moving conditions. A limit order is more controlled. It executes only at your specified price or better. This ensures you don't overpay, but it also carries the risk of missing the trade if the market never reaches your level. Algorithms often use limit orders when accuracy is more important than speed. A stop-loss order is your safety net. It automatically closes losing positions once price moves against you beyond a defined level. No serious algorithm should run without one because it prevents small losses from becoming catastrophic. Finally, a take-profit order locks in gains when price hits your target. It ensures you exit winners consistently without second-guessing yourself. Together, these order types form the toolkit that allows algorithms to execute systematically, protecting capital while enforcing discipline. Financial markets aren't always calm. They can move violently within seconds. Events like the 2020 crash showed how quickly prices can collapse, leaving manual traders struggling to react. Algorithms, however, execute trades based purely on logic, not emotion. Fear and greed don't influence their decisions. Because algorithms run continuously, they can monitor markets around the clock, entering and exiting positions with consistency. This 24/7 coverage ensures no opportunity is missed while you're asleep or away from the screen. But volatility introduces a hidden cost: slippage. This occurs when orders fill at worse prices than expected, especially during fast price swings. For example, a market order placed at 1.2000 might actually fill at 1.2005 in volatile conditions. Expert advisors mitigate this by using advanced order management, splitting large orders into partial fills or routing them to the best available prices. In this way, automation not only removes emotion, but also helps minimize inefficiencies caused by unpredictable market movements. By now, you can see why understanding markets is the cornerstone of algorithmic trading. Whether it's Forex with its endless liquidity, commodities with their cycles, indices with broad exposure, or crypto with non-stop volatility, each market offers unique opportunities and risks that algorithms can be tailored to exploit. We've also looked at brokers, the infrastructure that routes trades within milliseconds, and the need to choose providers who can handle automation demands. Equally important are order types: market, limit, stop loss, and take profit, that form the building blocks of any system. Together, they create the structure in which your expert advisors will operate. Finally, we saw how automation thrives in volatility by executing strategies consistently and minimizing slippage through advanced order management. These aren't extras, they're necessities for real-world trading. With these foundations set, you're ready to explore the tools where it all comes together. In the next lesson, we'll dive into MetaTrader platforms, MT4 versus MT5, the industry standard for building and running expert advisors. You'll see how they differ, how to set them up, and why learning MetaQuote's language, MQL, is essential for programming your own systems. This is where theory turns into practice.